Hello, my name's Tony.
And my name is Linda.
Today, we're going to talk about automating your approach to investing. Avoid procrastination by linking your brokerage account to your checking or savings account. Then, set up to have a specific dollar amount pulled from your bank account into your brokerage account each month. Most online brokerage firms enable purchase of fractional shares. You can start investing with small amounts and increase the amount you invest with each raise that you earn from your employer or business. Next, determine what it is that you want to invest in, whether you like specific stocks or prefer low-cost, broad total market index funds like us. You can automatically buy more shares each month. We've taken a set it and forget it approach to our investing. If you're set up for direct deposit with your employer, you can truly automate your investing strategy. As you earn money, it goes into your bank account, transfers to your brokerage account, and then into specific shares that you select.
Life gets busy, and if you are like us, you can come up with many excuses to put off investing in the market. Some examples include, the market is overpriced, or I will buy on the next dip, and so on. We don't try to time the market. We have bought when it was high, and we have bought when it was low, but we buy a little bit every month. Over the years, that strategy has worked for us. That doesn't mean that it always will. The market could tank tomorrow and take years to recover. However, that just means we will be buying lower each month than we have been. We are long-term investors.
Start early. The sooner you start, the better. Compounding interest is an amazing thing. Consider two investors. One starts investing at age 25. They put in $5,000 a year and earn an average of 8%. They only invest for 10 years and then stop. The second investor doesn't start until they reach the age of 35, a full 10 years later. They also put in $5,000 per year and earn an average of 8%, but they continue to do so for 30 years. Which investor will have more when they retire? The one who started sooner. The compounding interest from those 10 years add up to $787,180. The person who waited had an account balance of $611,730, even though they invested 3 times as much as the person who started earlier.
That does not mean you can expect the same return. No one knows what market returns will be going forward. The point here is that the earlier you start, the longer your money will have to compound and work for you. The sooner you start, the sooner you will achieve financial independence. Those fractional shares will add up to full shares. Depending on your investment, those full shares may produce dividends that you can reinvest into more fractional shares that will equal full shares. That is the power of compounding.
Whatever your investment choice, consider rebalancing your portfolio once or twice a year. If one of your investments has done significantly better than another one, you may want to sell some of those shares. Then invest more in the one that hasn't performed as well. You would only do this if you truly believe that the one that's not performing is a good buy at the current market price and will go up in the future. Consider capital gains taxes before you sell any shares. You can rebalance without selling shares by changing the ratio of how many shares or fractional shares you buy going forward. These are decisions that you should make with your financial advisor. If you don't have a financial advisor, then do your own research and make decisions that you feel comfortable with.
The point of this video is to automate your investing. Start now. Don't procrastinate. Dollar cost average your investments by buying additional shares each and every month. Click on the link to our next video where we will talk about some specific total broad market index funds.
Thank you.